Welcome to the world of value investing, where the key to wealth is not chasing the latest hot stock but finding companies priced below their true worth. It's like being on a treasure hunt, but instead of seeking buried gold, you're searching for undervalued stocks that promise long-term growth. Did you know that during the financial crisis of 2008, some investors made millions by purchasing undervalued stocks that everyone else was ignoring? For example, shares of Ford fell to just $1.89 in November 2008. Fast forward to 5 years later, those shares were worth 10 times that amount. This is the power of value investing, spotting potential where others see peril. In this video, we will dive into 6 legendary investments that demonstrate the incredible potential of value investing. From a textile company turned global conglomerate to a tech giant that nearly hit rock bottom, these stories are not just about stocks and money. They are tales of patience, insight, and the courage to go against the crowd. So, buckle up as we explore how you can apply these lessons to spot your next great investment. Whether you're a seasoned investor or just starting, there's a nugget of wisdom here for everyone. Ready to see what everyone else is overlooking? Let's get started. Chapter 1. Hidden Gems Unearthed. Value investing isn't just a strategy. It's a philosophy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Think of it as the stock market's version of a treasure hunt. You're essentially looking for quality stocks at a great price, much like finding designer clothes at a thrift shop. The father of value investing, Benjamin Graham, taught us that the secret to value investing is all about a stock's price versus its value. He famously said, "Price is what you pay, value is what you get." This distinction is crucial because it guides investors toward decisions that prioritize long-term rewards over short-term gains. One common technique in value investing is looking for companies with a high dividend yield. These are the ones that pay out a good portion of their profits back to shareholders. It's like buying a rental property. You're not just hoping the house goes up in value, you're also getting rent checks while you wait. Another strategy is to search for stocks with low price to earnings, P/E ratios. This can be likened to shopping for bargains. If the average P/E ratio in the market is 15, a stock with a P/E ratio of 8 might suggest that it's undervalued. Investors also keep an eye out for businesses with low price-to-book ratios. This compares the market value of a company's stock to its book value. It's akin to comparing the price tag of a car to what experts say it's worth. Value investing isn't about quick profits. Warren Buffett, one of Graham's most successful disciples, advises, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This highlights the patience required in this approach. Now, let's move on to a story that epitomizes the essence of value investing, the tale of Berkshire Hathaway. Chapter 2. From Rags to Riches. The Berkshire Hathaway bonanza. When Warren Buffett took control of Berkshire Hathaway in the mid-1960s, it was a struggling textile company. But Buffett saw something others didn't. He realized that by using the cash flow from Berkshire, he could buy other companies. This was the seed that grew into the massive oak tree Berkshire Hathaway is today, a conglomerate owning everything from railroads to candy companies. Buffett's strategy involved buying businesses with durable competitive advantages at fair prices. It's like finding a sturdy, well-built house in a prime location at a reasonable price. The initial price tag might seem high, but the long-term benefits outweigh the cost. One of Buffett's famous investments under Berkshire was in See's Candies in 1972. He bought it for $25 million when it was making about $4 million pre-tax. Now, it makes that much in a single week during the Christmas season. This demonstrates the power of understanding a brand's intrinsic value. Buffett often focuses on companies that are not just businesses but institutions in their sectors, with loyal customers and a solid reputation. He once quipped, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Through Berkshire Hathaway, Buffett also made significant moves in the insurance sector. By acquiring companies like Geico, he capitalized on their ability to generate float. This float, or available cash, is like having a loan that you don't have to pay interest on, which can then be invested in other areas. By the end of the 20th century, Berkshire Hathaway's stock was selling at over $70,000 per share, highlighting an extraordinary return on investment that spanned decades. Buffett's ability to see beyond the present state of his investments to their potential future value has made Berkshire a prime example of value investing success. Chapter 3. Tech treasures. Apple's core investment. The story of Apple is not just about innovation, it's a prime example of how value investing can work even in volatile sectors like technology. In 1997, Apple was on the brink of bankruptcy. However, a strategic investment by Microsoft and the return of Steve Jobs signaled a turning point. Investors who recognized the underlying value amidst turmoil had much to gain. Apple's turnaround strategy focused on simplifying its product line and fostering innovation. This culminated in the release of groundbreaking products such as the iPod and iPhone. These weren't just new gadgets, they revolutionized how we consume media and communicate. In terms of financial metrics, Apple's price-to-earnings ratio and other financial indicators dramatically improved post-2001. Investors looking for value saw that Apple had strong fundamentals, an iconic brand, and was undervalued given its potential for market dominance. Jobs famously stated, "We're here to put a dent in the universe." This vision resonated with investors who saw Apple's potential to disrupt industries. By focusing on the company's capacity for innovation and market expansion, they invested not just in a company but in a vision. The result? Those who invested in Apple before its resurgence saw extraordinary returns. For instance, a $1,000 investment in Apple stock in 2001 would have grown to over $200,000 by 2020, illustrating the massive potential of value investing in tech. Don't forget to subscribe if you're into this, and let's move on to the next part. Chapter 4. Pharma's Phoenix. The Allergan acquisition. The pharmaceutical industry often presents unique opportunities for value investors willing to delve into complex valuations and regulatory environments. A noteworthy case is the acquisition of Allergan by activists in 2015. Originally, Allergan was seen as an undervalued asset, laden with potential that the market hadn't fully appreciated. Activists, recognizing Allergan's undervalued state amidst a hostile takeover attempt by another company, stepped in with a better offer. The deal valued Allergan at approximately $66 billion, a testament to seeing beyond the immediate market turbulence to the underlying value. What made Allergan attractive? It wasn't just their portfolio of well-known drugs but also their promising pipeline and strong profit margins. Their strategic focus on brand reinforcement and expansion into new markets signaled potential for sustainable growth. The acquisition strategy employed here highlights a common value investing principle. Look for companies with solid fundamentals that may be overlooked or misunderstood by the market. The activist-Allergan merger allowed activists to utilize Allergan's existing strengths and synergize them with its own, leading to enhanced market presence and profitability. This case also emphasizes the importance of strategic foresight in value investing. As Warren Buffett notes, risk comes from not knowing what you're doing. In the case of Allergan, activists' clear understanding of the pharmaceutical landscape and Allergan's strategic value minimized their risk while maximizing potential gains. Chapter 5. The Real Estate Goldmine. Simon Property Group. Real estate can be a treasure trove for value investors, especially when market downturns depress property values. A striking example is Simon Property Group, a giant in the world of real estate investment trusts, writes. During the Great Recession, Simon Property saw an opportunity to expand its empire by acquiring premium outlets and malls at bargain prices. Simon Property Group specializes in retail properties, a sector often viewed skeptically by investors due to varying economic cycles. However, their strategy of focusing on high-traffic, upscale locations has proven resilient. Even when online shopping surged, Simon's destinations remained attractive for their experiential offerings, showing that not all retail spaces are created equal. The company's ability to maintain high occupancy rates and attract leading global retailers provides a buffer against market volatility. This strategic positioning allows them to generate stable rental income, which is key for any REIT. Their dividend yield, often hovering above the industry average, is a testament to their robust financial health and appeals to income-focused investors. Simon Property Group's approach underscores a vital value investing principle: understanding the asset's intrinsic value. Their focus on premium properties in prime locations allows them to command higher rents, which translates into greater returns for investors. Warren Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Simon Property exemplifies this by not just surviving but thriving, despite broader challenges in the real estate market. Chapter 6. Beyond the Balance Sheet. Intangible assets and hidden values. When it comes to value investing, sometimes the most significant assets a company has are not found on its balance sheet. Consider Disney's acquisition of Marvel in 2009. At $4 billion, some analysts thought Disney had paid too much. However, Disney was buying more than just characters and stories. They were investing in a vast universe of intellectual property that could be leveraged across movies, TV shows, theme parks, and merchandise. Disney's Marvel acquisition highlights the importance of intangible assets like brand strength and intellectual property. These assets can be difficult to quantify but may hold immense potential for generating revenue. Since the acquisition, Marvel films have grossed over $22 billion worldwide, a clear indication of the acquisition's value. The ability to recognize the potential of intangible assets requires a deep understanding of the industry and the company's strategic positioning. Disney knew that Marvel's characters had a global fanbase and timeless appeal, which could translate into multiple revenue streams over time. This strategy emphasizes another value investing principle. The future value of an asset is not always reflected in current financial statements. As Benjamin Graham noted, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Disney's long-term view on Marvel's intangible assets has clearly tipped the scales in their favor. These chapters illustrate how diverse the application of value investing principles can be, from real estate to intellectual property. Whether it's a tangible asset like property or something less tangible like brand reputation, the core idea remains the same: look beyond the apparent to uncover true value. Don't forget to subscribe so you never miss an update from us.